Good morning, and thanks for joining us for our webinar this morning focused on the 2016 crop outlook. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me this morning are my colleagues, Dr. Chris Hurt, who's a professor of agricultural economics, and David Widmar, who is a senior research associate in the Center for Commercial Agriculture. And we're going to focus a little bit on the two reports that were released by USDA yesterday and discuss the outlook this morning. But if you've got a question that we don't address, you can email that to me at my Purdue address, which should be on the screen right now, jmintert@purdue.edu. And we'll monitor those questions and monitor that email during the course of the webinar and try and address it during the webinar. If we're not able to do that, we'll respond to you individually by email later today. So with that, Chris, let's talk a little bit about the outlook. And we got two reports yesterday from USDA, one on the grain stocks and one on planted acreage. And I think it was a good example of why we actually have the reports, because the reports did not match the pre-report expectations.
Well, that's right. And obviously, this particular late June reports, these reports have some history of bringing some fireworks. And as we think about the fireworks, obviously we're getting near the end of the marketing year. So the stocks, how much grain is left, it really gets to be very important in regard to how much final carryout is going to be. And then acreage, of course, we all know that that March planting intentions report, the prospective plantings report, a lot can change after that early March reading, so what actually got planted. As we look at those numbers, we'll first look at the stocks situation. In terms of the corn, we saw the stocks on corn were higher than what was anticipated in the pre-report expectation there in the middle of the visual. Now that was about 200 million bushels more stocks than what the trade had been anticipating. So this could be something with last year's crop. Maybe that was too low on the estimate. But more likely it could be usage is somewhat lower than what's been anticipated, and that says we just haven't used as much. Anyway, that's something we'll see USDA, if they make any adjustments in the balance sheet. We'll talk a little bit more about that. But 200 million more bushels, that's a number that at least gets your attention. When we combine that on corn with the more acreage than expected, more inventory of old crop, more acreage of new crop, okay, that's a double whammy, more supply. On the soybeans, also saw the stocks number higher. You can see they're about 37 million bushel higher than the anticipation. Again, was last year's crop underestimated? Was usage not as strong? We'll see how USDA sorts that out. Now in soybeans, we had a surprising reaction to most of us anyway in the price reaction. And that is the stocks report clearly was on the negative side to prices. You would expect some lower prices with higher old crop inventory. And we'll look here in a second, but the numbers in terms of the acreage were neutral. So if you take one of the reports, stocks was a bearish report, bearish tone. The acreage was neutral on beans. You'd say, somewhat down on beans, and they just exploded to the upside. So we'll have to talk a bit about that. Then on the wheat, we had the stocks report was right on the money with anticipation, but we did have more acreage of wheat. So again, you'd get a little bit of a negative tone overall. So let's look at the acreage report and see how that stacked up. I've mentioned these, but again on corn, we had more corn acres than were anticipated, almost 4 million bushels more acreage on corn than the trade had anticipated in this report. Soybeans very close to neutral, as we said, on the acreage, and more acres of wheat as well. So one of the themes we saw coming out of that report is, as we look at prospects for production of the 16 crops, more acreage in general than what the trade had anticipated.
And Chris, the surprise there really was on the corn side with respect to the fact that we've been looking all spring at the fact that returns seem to favor increasing soybean acreage. We've been talking about that for
right.
several months. We thought that would actually be the case, and that's really the surprise. What do you think drove that?
Well, again, I think this is right. And the last time we did a crop outlook in the end of March, we really emphasized that they had too many corn acres. We needed to get that down. We needed to rebalance corn acreage, drop corn acreage. The world needed beans. That's what the world needs, but that just hasn't happened. And I think as we look at why did the corn acreage get so high, first thing we'd say is the spring was relatively clear in terms of getting the crop in the ground. We did have very good weather going into late March and very early April. So Dave, you'd mentioned a lot of field work got done, probably a lot of anhydrous got put on, and once that commitment was made to nitrogen, then they went with corn. Our producers tell us they like to raise corn. They're producers, and corn produces a lot of volume. Now again, I don't buy into that argument. I think they're business managers and make logical choices. But again, we would go back after the fact and say, I wish we could have gotten those bean acres, because now we've set up a situation where bean prices certainly are going to be higher. Beans are what the world needs. And guess what we've got a lot of? Corn and wheat, which the world doesn't need right now.
All right, let's take a look at that from a little more of a longer-term perspective,
Sure.
Chris, with the chart that you've got here that goes back to the mid-1990s.
And again, the top line is the corn, the long-term perspective, more corn, more corn, more corn. We especially see that growing in starting around 2007 to 2012, 2013 crop. That's the ethanol boom that we had to get substantially increased acreage to meet that 3 billion bushel increase in total need. Now again, if you're looking at corn, the 88 million acres last year, we'd already been in a process of reducing corn acreage overall. The big growth since about 2011-12 has been in soybeans. It is the Chinese continuing to buy more soybeans in the world market. That's what's growing. Corn need is growing a little bit with ethanol and feeding need, but that big growth was the 07 to about 2012. Now, we're over on the right-hand side of this visual, we're showing the last two entries are the March and the June. And what we want to see, just looking at the last two, is that in all cases, corn, soybeans, and wheat, the June estimate on acreage was higher than what the March estimate was. So again, it was there was the surprise that we got more corn. The market was anticipating lower corn. We thought the financial incentive to shift out of corn late in the planting season and to more beans was strong enough. We were measuring on our budgets over $100 advantage in Indiana to plant soybeans for 2016 versus corn when we got out to about early May. So again, more acres than what the market anticipated across the board, corn, soybeans, and wheat. I think, again, the longer term message here is that it is soybean acreage that needs to grow as we move forward, and we didn't take that opportunity in this country. Farmers did not jump on that opportunity. So who's going to jump on it? The South American farmers are really going to jump on that opportunity to supply the world with beans where the growth is at as we get into their harvest next February, March.
And Chris, that's a good point, because I think that has some implications about how we should go about marketing the 2016 soybean crop here in the U.S.
That's right.
Anticipating what could be a large supply of South American soybeans next winter and spring. And we'd want to perhaps do some pricing and some marketing well in advance of that anticipated surge in supply coming out of South America.
So I think that's, we've got very strong prices now. We'll see what weather does. We'll talk about that in terms of the rest of the growing season, how the U.S. crop comes out. But then now the anticipation, who's going to fill this void of not enough soybean production in the world, at least relative to corn and wheat? That's going to be South America. So that anticipation of a huge South American crop keeps us nervous about storing beans all the way into spring and summer of 2017, at least at this point.
David, I think when we look at the acreage numbers, I think one of the things that was going on there was the shift away from the prevented plantings that we saw last year, right? I mean, we had a lot of prevented plantings in 2015. We didn't get those in 2016.
Especially there in Missouri, a lot of soybeans out of Missouri and a little bit of corn just didn't get planted last year. I think it was 3 million acres in Missouri. Was that?
Well, it was about a little short of 2 million
2
prevented
million.
planting in Missouri alone.
In Missouri alone.
And Illinois had about 500,000 acres. So
There's a pocket there where lots of rain were traveling up through the spring and kept farmers out of the field. This year we've seen a little more favorable weather, and those acres look to be planted this year. So we don't see a huge prevented planted acreage situation in 2016.
And that kind of helps explain the numbers we're looking at on that chart with that increase in acreage,
I think
right?
that's what we're looking back to. We talked about this in our March webinar as well, that there was this pool, and I think we've got it actually on the next visual here. Well, I guess we don't have it there, but that didn't seem to get counted in the March estimates. What do we mean by not counted? That there was still this 5 million or 6 million acres from last year didn't get planted that wasn't showing up yet. And of course in March we didn't know whether we would get that planted, our prevented planted would be high or not.
And in terms of explaining why some of those acres wound up going to corn, I suspect some of those acres were intended for corn last year. And we shifted some things around, probably planted beans on some acres that would have gone to corn in 15. So from a rotation standpoint, maybe that helps explain a little bit of what took place with the increase in corn acreage that we saw this year.
Yeah, and again, we looked at this geographically, and it was just universal across the country. All states wanted more corn. And I shouldn't say all states, but if you look regionally, all areas just really went to corn. So a little bit surprising. Did they miss the price signals? Are our budgets off? So still some question marks, but again, this is what USDA says. Too much corn, too much wheat, not enough soybeans. Just looking at those numbers from last year, of course, our acreage, 88 million acres and 15 on corn. So there's your big surge in acreage this year, up 7%, soybeans up 1%, wheat down 7% in terms of acreage. Here's a little bit more. Dave was talking about prevented planting. So if you look at principal crops, now this includes all the major crops, minor crops, dry edible beans are in these acreage numbers, and harvested hay is in these numbers. But you see we were up over on the right-hand side almost 5 million acres from last year. And as Dave was saying, there in the center under the heading of that, prevented planted acreage last year across the country was 6.7 million acres. So this 5 million additional acres we saw come in appears to mostly have been that prevented plant that came back into production. Now normally, even in the best of years, we have 1.5 to 2 million acres of prevented planting. Someplace, somewhere, some farmers have trouble getting the crop in the ground. So I think it's prevented planting that got back in. They did get that planted this year. Farmers were hesitant to report what they didn't get planted last year back in March.
Let's take a look at stocks to use ratios on a worldwide basis, Chris. And of course, I think the first thing to point out is these are actually the USDA numbers that were released a couple of weeks ago. These will get updated here in early July, but let's talk these through a little bit.
Yeah, we'll start with the red line up at look at that over on the right-hand side, 36% ending stocks as a percent of the year's use. So that's over a third of a year's usage sitting in the grain silos when we're ready to harvest another crop. So it's a very large inventory, and this spans back to the left, back this century to the 2000 crop. So we are at the highest world inventories of wheat this century so far. That doesn't give us much prospect of really strong wheat prices. Now, as we look at the corn situation, that's the blue dotted line at the bottom. And what we see going over to the right-hand side is that up until the 15 crop, and that's marked as the 15-16 crop, start on the right-hand side and move in one to the left, 21.3% stocks to use. That had been 4 years of growing. So we had growing stocks going back to the 2011-12 marketing year. And up until just about April and May, we were really anticipating even higher growth for the 15-16 marking year. What happened was we trimmed about probably 250, 275 million bushels out of the South American corn crop, and that's kind of leveled off 15-16 with a little bit of movement down in 16-17. Now, Jim, you already pointed out that with this additional acreage in the United States, with the additional stocks of corn, USDA most likely that 16-17 is going to be revised up somewhat so that it's not much different than the last 2 years. Kind of gives us a clue. If stocks aren't much different, maybe prices won't be much different. 350, 360 corn may be the kind of category we'll be talking about. The dotted line, that's soybeans. There's where we've got some difference. And as you look at the soybeans, the 15-16 major reduction in the 15-16, that's the next to the last on the right point, and that is we saw about, a similar reduction in soybean production in South America. Probably going to be on the order of 275 million bushels less soybean production. And of course that has big implications for the U.S. because China, the big buyer, was planning to buy a lot of those beans out of South America, and guess what? Since April, May, and continuing into June, we've seen China and other buyers of the world come to the U.S. to replace what they thought they were going to buy out of South America. So this has really changed the soybean situation. Now let's fast forward to the very last point, which is hidden there, but 16-17 on the dashed line, and those projections, the June projections from USDA, would be that soybeans will be the tightest world inventory. If you can go back to the middle of the graph, 08-09. We're in beans in the teen category with that kind of an inventory number. So what you see is an abundance of wheat, corn, maybe not a lot of progress in world inventories with these higher numbers from the U.S. staying pretty high, but soybeans, the one the world is short on. So I think we see the overall picture on price right here with these inventory numbers.
And this graph really captures what the market's also saying is that downward pressure on wheat prices, downward pressure on corn prices. We have stocks that are relatively high. They've been several years of growing, and then that upward momentum in soybeans as stocks, as measured as a percentage of use, have been declining over the last few months.
And again, you know, we have some sense as people that work with these markets and provide education, how were we not able to get this message to U.S. farmers? It's not corn we need, it's more beans we need. But that's where we sit at this point, so we'll have to move forward.
The good news, that creates an opportunity for a lot of soybean producers, a lot of corn soybean producers
Sure.
in the U.S., especially between now and the time when that potentially large
That's right. And
South
with these
American
tight
crop hits.
margins we've had, we had $8.50 soybeans. So it looks like we're going to replace that with something much better. Maybe corn and wheat, we don't get much better prices, but at least soybeans, and that's certainly important to the corn belt overall.
So Chris, we've talked about grain stocks, we've talked about acreage. Let's talk about yield prospects.
Yeah, so now that's kind of where we're at. Let's start talking about where's the crop at as best we can measure it at this point. And then I think we're going to talk a little bit about what's coming for the rest of the summer, because we all know weather still hasn't played the card for sure. So one of the things I do is look at the weekly USDA crop condition reports, and you'll see in the top rectangle there some percentages. So let's look at U.S. corn, and U.S. corn, the crop report released on this week for the June 27th, 6/27/16. What I'm doing is I'm looking at the crop condition this week, this year, this week, and comparing that with the other crop conditions for each year going back to 2000. And then putting that into a distribution and measuring the percentile. I've got this year's crop ranked at about the 82nd percentile. What does that mean? 50th percentile would be an average crop compared to the crops going back to 2000. 82nd percentile, the 80th percentile would say it's the 8th best out of 10 years would be a way to interpret that. It's a good crop. It's a U.S. crop. If you use those USDA enumerators evaluation, it's a good crop at this point. Is it the best? No. Is it average? No, it's an above average crop. U.S. soybeans, about 90% percentile, so that's best crop, ninth best crop out of 10 years, very strong. And you can see the numbers then for Indiana, not quite as strong as the U.S., but still an above average crop. And we take those numbers and throw them into a model to try to make some estimates. And essentially what we say is taking the crop conditions at this point, if we have a normal weather for the rest of the summer, then here's where we would end up on yield. For U.S. yield, USDA, they are using a trend yield at 168, and my model's coming up 171 bushels as of this week. So 2 to 3 bushels better than trend. Well, if the crop condition is better than average, it would seem reasonable. We might have yields somewhat better than average. And soybeans, 46.7 is where USDA is at in that bottom rectangle. And this model comes up with about a bushel better yields than that, 47.8. So my bias at this point is to say, at this point, if you had average weather for the rest of the growing season, we will end up with above trend yields. Now we got a question, what's the weather going to be for the rest of the growing season? And so I think we need to talk about that.
And you know, an interesting point there, Chris, is that if you look at the weather impacts going forward, we're getting close to the point where weather might not make a big difference on corn yields, but could have a pretty big impact on soybean yields, and that makes the rest of the summer at least pretty interesting. David, you've been looking at the weather, looking at the drought conditions relative not only to last year, but relative to maybe some bigger drought years. So let's take a look at that real quick.
Yeah, a lot of the conversation that started in May and into June was talking about some dryness that was developing. A lot, as you can see here on the U.S. Drought Monitor map, a lot of dryness starting to show up in northern Missouri, eastern Kansas, eastern Nebraska, southern Iowa. That's been a conversation piece that's been in the markets quite a bit. There's also a pocket of dryness down there in the southeast. If you look at this map compared to 2012, it's not anywhere even near the amount of drought that we already saw at this point in the growing season in 2012. So at this point, at least, conditions aren't pointing to a repeat of 2012. So while you could see some optimism for if you're hoping for prices to go up, you're hoping for a shorter crop to support prices, there could be a little bit of optimism in this. But if you were to look at the 7-day forecast right now, there is a big band of rain getting ready to cut through Kansas, Missouri, and Iowa. That's probably going to really be timely and very beneficial for that corn crop as it's heading into that critical tasseling stage. And so it's really hard to take a lot of building off Chris's comments about it's a good-looking crop. It has potential to be above trend. Yes, there are some dry areas out there, but with the 10-day forecast, it's really hard to bet a lot that we're going to have a below trend, especially substantially below trend crop heading into 2016.
Backing up a couple of weeks, though, David, there was that concern because we started off in June, the first week or 10 days or so, with what appeared to be some pretty dry conditions. Some above average temperatures in some places, and I think some people in the marketplace were concerned we could see, if not a repeat of 2012, at least something that might approximate that, right?
Yeah, anytime, here in Indiana we were in the 90s and we were several days of dry, hot conditions, that starts to get things going. We're 10, 15 days in early June of that continued pattern sets us up for a dangerous scenario going into July. Now we're here July 1st. We see a big storm moving through the heart of the Corn Belt. We've seen some rains in other parts of the Corn Belt since then. So right now the forecast is looking like warmer temperatures, but also some precipitation in there. So that's definitely going to help the corn as it's heading through the growing season. The U.S. Climate Center also provides a forecast of what the drought monitor is going to look like. This is through the end of September, and so you can see that pocket of drought there in the southeast kind of persists, but they're actually forecasting for that pocket that we saw in the earlier graph not to really build. So we don't really see widespread dry drought conditions based on this forecast through September.
Yeah, and again, I think it's important to point out that we have a fairly traditional summer pattern in terms of weather, and that is it's thunderstorm activity, and thunderstorm activity is often scattered, and there are dry pockets that set up. generally we think about drouthy conditions as a blocking out of precipitation. There just are fairly major geographic areas that it cannot rain. We really haven't seen that this year. I think it's much more of a traditional kind of a summer weather pattern. But boy, the talk about La Nina coming in, Dave, there was that was really hit. I was hearing that back in January and February. Don't sell any grain because La Nina's coming, and La Nina's going to give us a hot, dry summer. So what's the update on that? National Weather Service here is not suggesting, this is through September, that we're going to have a tendency to turn to drought in the Midwest.
Yeah, so last year we had a very strong, record strong El Nino, the opposite of La Nina. And so on the heels of El Nino typically comes a La Nina. If one's strong, typically the other one's strong as well. And so that's what got this conversation started in June, is once the El Nino conditions began to fade, and now they've since faded to more of a neutral range, the talk now is does an La Nina begin, and what's the timing of that? The timing is very, very critical. Earlier in the year, we might have suggested we could see those conditions starting now. Right now, the best estimates out there are saying for that August, September, October window, there's about a 70% chance of La Nina conditions setting in. So those that are bullish to the upside for commodity prices have been focusing on this potential for dry, hot weather. And this is where I guess that's most likely to occur right now based on all the information we have. Now, this drought outlook that we have shown in front of us, that doesn't capture that as of now. So there's a little bit of a uncertainty there building, but right now there's a 70% chance of La Nina conditions building into this fall, and that could be coming at an important time as soybeans begin to wrap up their maturity in their grain filling stages.
Yeah, so the interesting thing would be on the soybean side, because truthfully, if we get through the next 10 days or maybe 2 weeks, and we get some of that moisture that the National Weather Service is talking about coming next week, that puts most of the Corn Belt in pretty good shape with respect to this corn crop.
Yeah, and I think it basically says you've got a decent crop. Now, is it going to be a bin buster, or are we going to trim a little bit? But yeah, 2 weeks out, it's getting closer to a done deal.
But soybeans, if we have a hot, dry spell that hits in August and perhaps the very beginning of September, that could still have a big impact on soybean production here in the U.S.
And that would only build on already tight global supplies that Chris talked about earlier.
Yeah, so that is the scenario that would create the explosive situation that I think some people are thinking about.
Maybe we go back to wheat and talk about wheat. So how would La Nina affect wheat yields? It's primarily mostly winter wheat, or our biggest acreage is winter wheat. Wheat's going to be harvested, so it's not going to affect yields on wheat. It would have a lesser potential impact on corn, so it would be soybeans. It's the crop we don't have enough of is the one that could have an impact. So this gives price dynamics to the upside for soybeans more so than corn. And I think that, again, Dave, as you mentioned, when you look at those price patterns, that's part of what we're seeing. Traders know this. People know that corn is getting closer to being made. Soybeans are more vulnerable. And I did want to mention the La Nina conditions. The belief is that increases the probability of hot, dry weather in the Midwest.
Yeah, there's no guarantee with these scenarios. More of a historic trend of what.
And I think what this visual that we've looked at, that says National Weather Service hasn't bought into the drouthy conditions on into the later summer.
Yeah.
Now, are they right? Are they not right? Stick around and we'll find out when it comes to weather.
It's one more information source, right?
So there is opportunity for another weather rally, but that has really diminished on corn. Wheat would not be much affected other than the spring wheat in the upper Great Plains. It is really soybeans that you would say has still the higher probability of having recovery from a weather rally.
Good point.
Maybe making new highs.
Chris, let's kind of walk through the balance sheets here a little bit. So here's the soybean balance sheet, and you've updated the numbers with some of your own projections. So let's take a look at those.
Okay, so we'll start with the 15-16 marking year. That's the 15 crop we harvested last fall on soybeans. We're marketing now through August of 2016. And we've highlighted first the exports. And what we have seen on soybean exports, as well as corn exports, but we're talking soybeans here, is a sudden surge in soybean exports that started back in April, May, and is continuing here in June. Now, the numbers, these are my guesses, the 1850, 1.85 billion bushels, that's almost 100 million bushels higher than USDA's estimate for June. What we've seen is a continuation of very strong sales. We've been averaging about 25 million bushels of new sales for this marketing year each week for the last 4 weeks, 25 million bushels a week. Now, I've already increased that about 100 million, as I said, from what USDA had in their June update. Just go down and look at that carryout. That drops our carryout. USDA is about 370 on old crop carryout. I increased exports 90 million. That drops us to 280. Now, this pace that we're on right now, China buying aggressively from us old crop. Normally, we've quit selling or virtually quit selling old crop at this point because the world's feeding off of South American beans. That cutback in their production, we've really seen this surge. We have 10 weeks to go in the marketing year in terms of the reports on exports. At the current rate, 25 million bushels a week. If you did that for 10 weeks, that's 250 million. We only have 280 total. So you can see this argument in the bean market saying, oh my gosh, we could have, if we don't see a slowdown in the rate of exports on the old crop, we could have this tight situation coming here in August on soybeans. Now, what you'd expect is that rate of sales will really start to drop off, but that hasn't in the last 4 weeks. So this again adds that speculative possibility that we could really still tighten even more than this, that old crop soybean situation. And if you tighten the old crop, you automatically tighten the new crop as well.
That's a very important point. And this is the exports aren't something we would have been excited about 6 months ago. The change in dynamics with the tight South American crop has been relatively new with China buying. So this has been a huge shift in the soybean market.
It really has, and a psychological shift. I think if you think basically we're just headed down on price, couldn't find a bottom, and it really changed that all together. Now let's go look at the 16-17. That would be the crop we planted this year, and we'll mark it on into 2017. Currently, USDA has exports, China buying 5% more soybeans in the 16-17 marketing year. So a renewal of their rapid growth rate. And of course, they're going to buy more of those beans from the U.S. Currently and extending through next February and March until South America can replenish the supply. So I think this means USDA is going to really increase the 16-17 export numbers for soybeans as well from the United States. And even with the yields they're using, even with the higher acreage that they're talking about, that still gives us carryouts that are in the high 200 range. And what we end up with then is soybean prices more in the $10.50, $10.75, $10.50, $11 soybeans. And I did an outlook last week, and I said, well, maybe $10 soybeans, because I thought we'd get about 2 million more acres over on the soybean side, and we did not get that. So I think it really does put this upward pressure on the beans. And then I added another half a bushel over on the right-hand side to those production numbers, because I think the crop right now, you'd have to project it as somewhat above trend yield, but I still get over $10 soybeans. So I don't think the market's off base here trading above $11 soybeans, but I think when you're above $11 soybeans, my sense is overall we'll be below that, so these are pricing opportunities. Boy, the chart tells us a lot. Each of these tick marks is a week of time, so this goes back about 5 years. It's the November 16 soybean futures, most of its history. And what we see, that almost $12 mark, $11.84 over here on the right-hand side, going back to the 2013 to see prices at around that $12. So the bottom side's very worth looking at as well. We just go back 3 months, and we couldn't find anything to strengthen. We couldn't find the export market to strengthen. At the turn of the year, around the start of 2016, the dollar was strong. We couldn't sell in the world market. The world had plenty of everything. So that's a dramatic chart, but I think the vulnerability on that chart is down to the downside. We look at corn and we look at wheat. They have lost all of the rally we had. All of it is gone. Here's soybeans hanging up there, the 1150 mark we closed at yesterday on the November beans. That's a lot of downside down to 850. So there's a lot of vulnerability to the downside. When you see historically a market that has that much rally in it, it's often hard to make new highs. Now again, that's going to be probably weather related or export related if China just keeps buying these old crop beans because they're concerned about supplies in South America. Soybeans have a possibility of making new highs. I think corn and wheat probably do not. It's a high price, and boy, if we're not some of that priced, I think we want to look at that.
Chris, let's take a look at the corn balance
Okay,
sheet.
we always talk about corn first. Not this time. Beans are where the dynamics were. So a lot of continuation of kind of where we were on corn. Now, we've got under the 15-16 crop, USDA will be updating that here in the 10th, 11th, 12th of July. And the first point on feed and residual, the 200 million bushel approximately greater stocks number. If they're concerned about that, USDA, they'll probably drop the feed and residual. If we have more inventory, perhaps we fed less, or at least that would go into residual. I left that unchanged for the 15-16 crop year, but wanted to highlight that as where we may get a change. The exports, again, much like we saw on soybeans, the world has really turned to the U.S. this spring to buy corn. A very unusual pattern because obviously over the last 15 years, South America's increased production, been able to export more corn, and our sales generally began to slow down. We've seen sales accelerate April, May, and June on corn. I've raised that 100 million bushels on corn exports. We're believers, as we said, that we will see strong exports on corn continue obviously this fall, but into the South American crop into February and March, and then if they have a good crop, taper off. But that gives us strong exports for the 16-17 marketing year. We're not going to be able to push a lot above 370 this year, 15-16 marketing year. It looks like with projections I ran yesterday, we're going to be around that 370 price for this year. But we've got then with the additional acreage, with the additional stocks for the 16-17, some building back towards that 2 billion bushel mark. Over in the very right-hand side, I've put another 2 bushels of yield, and I'm coming up a little over 2 billion bushels of corn, and that's again too much. Keeps us in the 350, 360 kind of corn prices. And again, in the last week and a half, the corn market has returned from what looked like above $4 corn selling opportunities back to more like these numbers, 360, 350, 360 corn.
And I guess, Chris, if I think about it from a longer term perspective, that's what we've been talking about really over the last year or so, that as an industry, we need to figure out how to grow corn profitably at something between $3.50 and $4. It looks like that's in fact going to be the case again this coming year.
And even last week or before this report, I was more optimistic we'd be in the high threes, pushing towards that $4 mark. I think this report returns us kind of back where we were, mid $3 plus on corn. And that's kind of discouraging. Obviously, margin's going to be very tight on corn.
So
I think the important number from here is 2 billion bushels. When that carry out the ending stocks, when we start talking about 2 billion bushel or more, that's when we start to put a lot of downward pressure on the prices. As we start backing away from that, which we were thinking about early in June, that's when we saw those prices rally. And so anytime we see that ending stock start to creep towards 2 billion bushel in 2016, 2017, we're going to see some downward pressure on prices.
And we might talk just a little bit, we're talking about corn here, but the drag of wheat, that big inventory of wheat in the world and U.S. as we look at things like wheat feeding. And we're already hearing that there is being quite a bit of wheat fed this year. Now, Dave, you talked about protein on wheat over in your family's area in Missouri.
Yeah,
Arkansas.
yeah. We typically think about feeding wheat in cattle-producing regions in Kansas for the feedlots, or in eastern Kansas and Missouri for the cow-calf producers. And so, when you think about substituting corn for wheat, there's a couple advantages. One of them is wheat has a little higher protein traditionally than corn, so there's some opportunities to take advantage of that. And then a bushel of wheat weighs a little more than a bushel of corn, so you get a few more pounds out of that. Another phenomenon that we have going on right now that I've heard of anecdotally in the western parts of the country is that it's a strong, high-yielding wheat crop, but that also means it's low protein. And so not only are producers seeing low prices on the board and at the board of trade, they're also seeing discounts for their crop when they haul it in the market for low protein. So
if you discount the wheat price,
if you discount
to an
it
already
even
low
more,
price,
the motivation to feed that could be pretty strong this
Right.
year.
Yeah, and so again, I think the wheat is also dragging on corn, and we're going to feed more wheat, and it's harvest time for wheat in quite a few areas, and this is when you're going to feed the most during this summer.
Chris, you mentioned some concerns about maybe being a little bit depressed. I think this next chart's a little on the depressing side. This is the Dees corn futures chart going back to 13.
Yeah, we shouldn't be allowed to smile when we show this, with being here in a major corn.
At least not if
producing
you're a
area.
seller. If you're a buyer,
Yeah.
it looks a lot better, right? But
Well, that's right. Again, this is Dees corn going back most of its trading experience. We see the 450 mark basically kind of repeating the highs that we made from last year. Last year was flooding. It was weather related.
Prevented planting.
Prevented planting. We're not going to get the acres, et cetera, too many ponds out there. We touched 450 on this D16 contract, went right back there roughly this year. And as I said, this week, which is the very last bar on the right, and the week before this, second bar, we've lost all of the rally, every single penny of the rally that we got with the weather concerns and the fact that we were going to pull back on corn acreage. Didn't happen, and there you see the results. That's a disaster chart if you had hopes that we were turning the corner on getting some stronger corn prices. Right back to our lows of the winter and early spring.
So we traded the highs and the lows for the last 12 plus months within
In
just
the
a
last
couple
2
weeks.
weeks.
two.
In the last 2 weeks. And let's see, another point is how much opportunity do you have to sell at the high on this marketing year? And now each of those bars is a week. So you see basically above, about 420, you had parts of 3 weeks.
Hope you didn't take a long vacation. If you were
Especially during that time.
if you're on a long vacation in the middle parts of June, you might have missed that window.
My wife said, just go on vacation and forget about those markets. Right? Oh my gosh. So, big implications. What do we do now?
Let's take just a quick
my
look
gosh.
at the wheat chart, Chris, and then we'll move into some
Now,
implications.
nobody's allowed to smile on this one. This is July wheat, new crop wheat, obviously in harvest and about to finish up the maturity on this July wheat contract. That's disaster. There is no bottom on that chart. And on obviously corn and beans, we found a bottom. We thought we found a bottom. In corn, maybe not. The last 2 weeks on wheat, high yields, very good yields, lots of very good yields we're hearing around the states that surround us, and I think out in the western plains, very good yields. And that's what's being reflected here. Too much wheat, and we're going to have more than too much wheat with this very good harvest that we're having right now.
And all that's exacerbated by the world supply-demand situation, which we had on a chart earlier, right? With those world supply-demand stocks-to-use ratios of about, 36% on wheat?
That's correct. And we'd already reduced U.S. wheat acreage. We're already gotten the message wheat is not an overall great crop to be planting, and still it's too much because of the world situation in terms of surpluses in a lot of areas of the world.
All right, so we want to talk just a little bit about, has the change in prices impacted people's perspective? And of course, we've got the Ag Economy Barometer, and we'll just mention that briefly. David, this is one of the questions we pose to producers, turning to the general ag economy as a whole. Do you think we'll have good times financially or bad times in the next 12 months? David, take a look at that.
Yeah, so these data, the latest data here from March 2016. Our next update will actually be next Tuesday on July the 5th. We're going to be providing an update to this. But when we ask producers to take kind of a look at the next 12 months, we haven't seen a lot of variation in their responses over the last 3 or 4 months. In fact, 70+% of people or producers are saying the next 12 months are bad times financially. And that's a huge shadow, I think, casting over in the ag sentiment when producers, that many producers, see it as tough financial times ahead. So even though these prices are creating some improvements, we really haven't taken a big turn to the profitability side at this point.
It'll be interesting to see what the June numbers, which we release on Tuesday, actually show us, because we'll be looking at that here later today as we continue to work on those results. But we had the rally taking place in commodity prices about the time we were still collecting data, so that's going to be a little interesting. But looking at our outlook here, boy, the outlook doesn't look very good on the wheat side, doesn't look very good on the corn side. We've got some prospects for improved profitability on the soybean side, so that's really the only bright spot out there in terms of improving the perspective here over the next few months, it looks like, right?
I think that's right. And I think overall, then we have the report, yesterday's reports, and that probably overall drags us down a little bit on a national basis, corn and wheat combined.
So the question all of us have been getting lately is what does the Brexit vote last week in the United Kingdom actually mean with respect to the U.S. economy and more specifically the ag economy? So let's talk briefly about potential impacts coming out of that. And I think we've got the direct impacts on the screen there. We think those are fairly limited because on the ag side, our trade with the EU and UK is relatively small.
Yes, that's right. Soybeans are the biggest single of the commodities we're interested in. About 10% of our soybeans do go to the European Union, the 28 countries currently in the European Union. In terms of wheat, we're about 4%. And again, EU is an exporter of wheat, but there's always some trade, so that's not a big factor at all. And corn is under 2%, so it's very tiny. Cattle and pork are both less than 2%. Pork's actually less than 1%. So I think the direct impacts, are there going to be economic distortions in the European Union where they wouldn't be able to buy as much from us? Not a big impact there.
So I like to fall back on maybe one of the comments that we got from one of our colleagues, Phil Abbott, who's a professor in ag econ and has focused on international trade for much of his career. Right. His comment the other day was that he thinks the big impacts from Brexit on the U.S. would be the indirect impacts, right? So let's talk about some of those potential indirect impacts. And I want to say potential because we don't know for sure, obviously, but as we think about what could cause changes or impacts or affect us in agriculture, it's probably on these indirect side.
Yeah, these are the big question marks, the big unknowns, and I guess the great part for us is that these are going to take several years to unfold, and so we're going to talk about them today, and then we're probably never going to come back and revisit these. So
if they're big, we'll revisit them.
We'll revisit them. So it's kind of one of those ones that it's hard to hold us accountable for how we think about things today, but the big one I think has a lot of potential is a stronger U.S. dollar. We saw that right after the vote, the U.S. dollar strengthened, and the British pound actually hit 30-year lows. And when we think about industries such as agriculture, which rely on exports, we looked this morning, 20% of the value of ag production in the U.S. is exported. So when we think about a stronger dollar in the global economy, that's going to make it a little more difficult for us to get our products to export market. A second big indirect impact is could this result into slower global economic growth? And so thinking about the broad general economy, do we start to slow down as an impact of this restructure in the EU?
And importantly, not just the U.S. there, it's really markets around the world, and our concerns there would be largely about what does that do to demand for U.S. food products that we export around the world.
Yes, that's exactly the point, is that do we have does this induce some sort of slowdown in the global economic activity, and that limits income growth, which limits the abroad buyers to purchase U.S. commodities.
Just as an example, I saw one study that said Great Britain leaving the EU would slow EU growth by 0.4%. Now that's not a lot, but European Union's a big trader with Asia, the United States, and that has an impact, ripple impact across the world.
Those spillover impacts, right?
Less income means less buying power, and that includes our agricultural products.
And we're in an era of slow global economic growth to begin with.
That's
and so
correct.
when you think about somewhere like 0.4%, that could really be a huge
and Europe
slug.
at times has been near zero, and if you would drop that below, that's called recession. Now again, I don't think we'd see necessarily recession, but this is a lot of uncertainty.
Right. And of course, the third point we have up here is this a sign of less global cooperation, less global trade? Are we kind of signaling a new era maybe where trade agreements and international cooperation could be slowing down? And I think when you think about agriculture, again, 20% of the value of production here in the U.S. is exported. A slowdown or a change in that trend globally could have impacts to the U.S. ag economy.
Especially in the meats. You think about one of the huge success stories in U.S. agriculture the last 3 decades has been the tremendous growth in meat exports. And they have become very important across all the meats, but especially in pork.
Over 20% in pork we export now.
Poultry, very important.
And broilers around that 20%.
And over that 3-decade period, beef exports have gone from less than 1% of U.S. production to up in the range of 8 to 10% of U.S. production, depending on the year you look at. So clearly concerns about incomes around the world and that perhaps having an impact on our ability to export. And then you compound that with the dollar. Those are all long-term things, though. And I think, Chris, you made the comment the other day that on Monday, or actually I guess this next week it'll be on Tuesday, and to some extent today, obviously, we're going to focus more on shorter term things. We're going to focus more on the weather conditions and the impact on crop yields, et cetera. It's probably not going to be these longer term concerns we've put on the screen with respect to Brexit. So these are long term issues. They're not going to drive, at least in our opinion, short run changes in corn, soybean, wheat prices, right?
And again, I think one of the things we want to emphasize is that trade has been good for U.S. agriculture. Who benefits from freer trade? It's the low-cost producers. And in those commodities in agriculture where we are low-cost producers and really competitive in the world, opening up of trade is overall beneficial. So that's a basic principle. So now even on the political side, we're seeing trade being talked about with our presidential candidates, even in Congress, not as favorably looking at trade and the trade pacts that are out there. So are we at a point of fundamental change? And I think everybody can see, this could be a signal. Maybe it won't be a signal, but are we changing that direction of globalization?
And it's a concern for us. One final point, David, I think we want to take a look at the dollar value, because that's one of the things that we think could have an impact. We talk about exports.
Absolutely.
Dollar value is a big deal. So David, let's look at this.
Yeah, it's important to think that whenever we talk about China coming to buy U.S. soybeans, they're not just buying U.S. soybeans, they're buying U.S. dollars, and then with those dollars they're buying soybeans. And so a stronger dollar means that it's increasing the cost for them to purchase those dollars than subsequently those soybeans. And so the trend that we've really saw take off since late or mid-2014 is that dollar strengthening. We saw it jump from around 78, an index value of 78, upwards of 95 that we saw at the beginning of this year, January 2016. Since then, we've kind of came back off of those highs. We're trading now around that 90. We did see the dollar spike a little bit and as a result of that Brexit. And so this is an important graph to keep in mind. As we think about the exports that have been driving that short term, this 2016 demand for soybeans has been an important part of that. And as we look down the road further, kind of the indirect impacts of Brexit, we're going to keep an eye on the dollar and this, the exchange rates and how that plays out. So, we talk a lot about in 2008, 2009, 2010, all the demand components that were driving that income boost. But it's also important to keep in mind we had a relatively cheap or a low value dollar that helped fuel those exports. And now we've changed the tide here. And so the next year, do we stay at this 90 level or do we spike higher or trend lower. That'll be important to watch.
Yeah, so that's a concern because obviously a stronger dollar has the impact of making our products more expensive to our importing nations, right? And that's the concern going forward. And as you point out on the chart, David, there's potentially a pretty big impact. Well, let's kind of summarize this a little bit, and then we'll take a look and see if we've got some questions from some viewers. I guess I'm going to start off by restating the obvious. If you didn't think so before the reports yesterday, it certainly provided some additional confirmation that the corn and wheat rally appears to be over. We probably didn't really have a wheat rally to speak of. That's probably a little bit of a
that was a bump.
That's a little bit of a misnomer on the slide, perhaps.
The hopes of a rally is over.
Yeah, the hope of a rally in wheat's over. And the corn rally appears to be behind us, particularly if the next week or 10 days are favorable with respect to moisture and temperatures in the corn belt, because we're far enough along in this corn crop that if we get another week or 10 days of reasonably good production weather, as you pointed out, Chris, we're at least set up for at the minimum at that point of an average crop.
Yeah, decent crop.
Whether or not it becomes above average is still going to be determined.
Well, and I would gather, and even until noon Eastern time yesterday, there were quite a few producers saying, now the next time corn comes back on the next weather rally. And so I think this is a fundamental change in kind of our attitude about these markets, in the sense that it just really looks like that opportunity for the next weather rally has really been diminished. Now, does that say we can't come back some? Well, more than likely there will be some dry pockets out there. There will be some talk about maybe yields won't meet those expectations. But I think what we're looking at now we're really looking for, I missed the dollar opportunity. Now I'm picking the bottom again. I'm trying to find the bottom. So can we get a 20, 30 cent rally where I can add a little bit more to sales as I become more confident if I've got bushels to sell? And again, if we don't get very much of that, then we're looking at that second point. We're back to looking at storage. And one of the things storage does, we're reminded from last year, storage buys us time for something to happen. This year, something in the 15 crop, something did happen. South American weather turned adverse right at the tail end and trimmed their yields. So I think this is kind of excitement of the weather market. Okay, now I'm thinking, okay, if we don't get the rally, I'm going to make sure I put up another bin here late summer and get all that crop stored.
Looking at soybeans, we think taking advantage of these prices and the strength that we've seen would make some sense. Obviously cleaning out the old crop, but looking ahead to the 2016 crop, do some forward pricing. Yeah,
we'd always recommend, usually in the spring, 25 to 35% forward priced on the new crop. If your crop's looking good, you may want to add to that at these prices. Again, our perception is that we'll be below, as an average price on soybeans for this marketing year, we're going to be below the $11 mark. Prices, opportunities above 11 on new crop beans sure make a lot of sense to us. And then I think also on soybeans, we particularly talked early about being more aggressive marketing in the first half of the marketing year. That's September through February. Why? Anticipating at this point a huge response from South America to plant a lot of soybeans and taking off further price increases in the last half of the 16-17 marketing year from March through August of 17.
So be aggressive with respect to pricing soybeans these next few months, and certainly as we get into the fall and winter, in advance of South America's crop. On this corn and wheat side, are we at a bottom? Are we just going to trade sideways and look for some opportunities for maybe a little bump and take advantage of that? Maybe hold back a little bit. If you haven't already done some pricing, I guess what I'm really asking, Chris, is do we want to play catch up at this point, or do we kind of sit tight a little bit?
I think you sit tight, look at storage probably. If South America goes heavy to beans, they're probably going to pull back on corn somewhat, and that could keep our price opportunities for increasing corn prices through the storage year stronger than a normal storage return. So I think at this point we price what we think we need to price at harvest time, If we get some rally, probably weather related, in the next 2-3 months, we'd add to our sales. Otherwise, we plan to store and try to earn the storage returns, which I think will be a little stronger than normal.
Okay, so I was looking at the questions, and we did have one come in from a viewer in the Great Plains, and the viewer was asked us to focus a little bit on grain sorghum. We've talked about corn, wheat, and beans, but we really haven't talked about grain sorghum, and obviously it's going to be priced as a competitor or a substitute for corn. Any differences in the milo or grain sorghum outlook relative to corn?
We did see more substantial decrease in sorghum acreage. This is related to price. The Chinese had been buying grain sorghum aggressively as a substitute for corn, but have moved off of that program. So I think basically grain sorghum and corn move in the same pattern.
In tandem, yeah.
I think it's important to consider when we think about where grain sorghum's raised. The Southern Plains is traditionally a strong wheat producing area, and I think producers are going to be looking at their crop budgets in the next few months for wheat, and it's not going to be very favorable for wheat production. And so we could potentially see producers thinking about, do I plant wheat versus dryland corn versus sorghum or milo? I think that's going to be a big decision for producers to play out, because where we saw a lot of acres of corn this year were in Kansas, Nebraska, Texas, Oklahoma. So I think that we could see a repeat of that as producers look for the best economic return for their acre.
And following up on that, David, I know you've looked pretty closely at those budgets of dryland corn in the Western Corn Belt and in the Great Plains versus growing grain sorghum, and one of the advantages is the lower investment cost, right?
Right. Sorghum typically has lower seed cost per acre, a little lower on the fertilizer cost per acre, and so producers are going to be looking at ways to get innovative, and there's a big trend over the last 10-15 years to switch acres from sorghum to corn. And as we're looking for cost-cutting measures, especially when the Chinese were buying, the premiums were very strong. Now that that's faded a little bit, there's going to be a little bit of a trade-off, and especially if they're looking at moving away from wheat, where they're in a moisture limit area. It's a lot of times that sorghum or milo does really well in limited moisture areas.
Another rotation we hadn't mentioned that I think is a little significance here is we're looking at this rain over the next week coming through Missouri, southern Illinois, some of central Illinois, Indiana. What about double crop beans? USDA actually surveyed producers. They said they were going to only plant 5% of the bean acreage would be double crop. It was 6% last year. What does this rain mean?
When we look at the rains that are coming through the next 7 days, we look at the Drought Monitor in those parts of the country, it's all looking favorable, and then you add this huge price response, this price motivator
really
for them
high
to go
bean
out.
prices.
A lot of times producers say, well, I've already covered all my land costs for the wheat, or maybe they're looking to make up some of the losses in the wheat. They're saying I could go out there and add some seed and a little bit of herbicide, and so their marginal cost is relatively pretty low to try that double crop.
And the rewards could be high.
The rewards are
the
there. The
price
price rewards there, and the moisture's there, and so we could still see some double crop acres.
I think it's a good point.
Well, with that, I think we'll wrap it up. Thanks for joining us today. I want to remind you of a couple of things. First of all, a recorded version of this webinar is always available on our website. That'll show up either late today or early next week, but probably late today or maybe over the weekend. And let's see, we've got the Ag Barometer comes out Tuesday morning, so we'll have some updated information there on our website and the Ag Barometer website. And then the third thing is we have the Top Farmer Conference coming up next week. The Top Farmer Conference will be held here in West Lafayette. That's on Thursday and Friday of next week, the 7th and 8th of July. And if you're interested in learning a little bit more about it and you still want to register, you can still do that. Just go to our website and we've got the information there about the Top Farmer Conference. We'll have some of this information. We'll be talking a little bit about the outlook, but we've got some different people on the program, so we'll get a little different perspective. We've got Nathan Kaufman coming in from the Federal Reserve, Steve Meyer from Express Markets, and Steve's a longtime pork market analyst, and Phil Abbott, who's an international trade expert. We'll be talking about the things that they see impacting the U.S. ag economy, and then we'll have some other sessions as well focused on a variety of management topics. So we'd encourage you to take a look at that if you have an opportunity. And with that, we want to wish you a happy 4th of July on behalf of Purdue Extension and the Purdue Center for Commercial Agriculture. Thanks for joining us.